Okay, thank you very much. Well, I'm Ed Yardeni, and this is behind there. If you can see, is Max, one of my three King Charles Cavaliers. Max always likes to sit in on these conferences. He learns a lot. Actually, he snores a lot. So if you hear any snoring, hopefully it's not any of you. Um, I am the president of Yardeni Research. We're a small investment counseling group. We've been around since 2007 as independent of Wall Street. I had been on Wall Street for many years. I could read you my resume, but it would make it sound like I can't keep a job because, like a lot of Wall Street people, I jumped around quite a bit. We've been actually virtual since 2007. Everybody works from home or from wherever they like. So this is my home, my family office, my home office. My wife is in the business, and my son is in the business, and my daughter's in the business, and then we have some other folks that we consider to be family members in some ways. But again, we've been virtual since 2007. So ever since when the pandemic hit, we told everybody, "Welcome to our world." This is what we've been doing for a long time, and that's sort of become the new model for a lot of people, at least a hybrid version of that. Well, let me just get going here. We are a top-down shop. We focus on the U.S. economy, the global economy, the global financial markets. And we are very data dependent. We're very empirical in the way we do things. We let the data tell us where things are going rather than start out with a presumption of how things are going to happen and then kind of fight the data. So we try to be true to the data. Within that context, I should warn you that any data that supports our story is good data. Any data that does not support our story, there's something wrong with it. It's going to be revised. So you've been warned. With regards to how we see things, since the beginning of last year, I've been arguing that we are in a recession. However, I've been arguing we're within a rolling recession. I've had a bit of experience. I've been in this business for over 40 years. And the environment, I thought, could play out like the mid-1980s, the early 1990s, where in the mid-1980s, we had a rolling recession. In the energy patch in the 1990s, early 1990s, we did have a very shallow recession, but it was also a rolling one. It tended to be concentrated in certain areas like the S&Ls and the commercial real estate area. We had something that was a mid-cycle slowdown in 2014-15, and that was again related to energy prices going down and a slowdown in the global economy, but that didn't last very long. So I think, as you know, there's been a tremendous amount of pessimism, bearishness about the economic outlook ever since the Fed started raising interest rates at the beginning of last year. The reason for that is that people perceived that the Fed was behind the inflation curve. The Fed announced that they recognized that and that they intended to catch up with the inflation curve rapidly. And they were true to their words. They did, in fact, increase interest rates dramatically. Got somebody's hand in the screen.
Steve, you got to move there, sir.
I do remember me, Steve Carter.
I see that there's a Dunkin' Donuts cup there in front of Marty. It reminds me of Game of Thrones. I think there was one scene where there was a Dunkin' Donuts cup in there. So
yes, we like to think of this chair as the Iron Throne. Yes.
Yeah, really. Yeah. So where are we now? I think we still have a recession rolling through single-family housing, but it looks like it's just about over. Interest rates have come down in the mortgage market, and that's I think providing a bottom for the single-family housing market. The multifamily housing market has been very strong, but I think there's some signs that it may be slowing down, maybe even going into a bit of a recession, because there's been a lot of building, especially in parts of the country where people are moving to the south. And there may be some overbuilding going on there. We have seen rent inflation coming down, which obviously is good for the inflation outlook. We've had a rolling recession in retailing. I don't, I just relate to you that when the lockdowns happened in 2020, we had about 8 people in my house during the lockdowns, and all family members. We all got along. We had our 3 King Charles Cavaliers and a little Yorkie that my mother-in-law has. But by May, when the lockdowns were starting to be lifted, but we all kind of still stayed home, my wife in early May said she had to get out of the house. And I said, "Why, honey? We've been getting along just fine." She said, "Well, spring is here. I want to buy something for the backyard where we can all have our meals out there." So she went to the garden center and in early May and bought a really nice set. The salesperson told her that was the last set they had available. So we all got locked down. We all got cabin fever. We didn't get COVID if we got locked down, I presume. But we all got cabin fever. And when the lockdowns were started to be lifted, there was some savings that occurred during the 2 months of the lockdowns. And then there was 3 checks that the government deposited in people's accounts. And so there's a huge buying binge in goods. And retailers ordered like mad to restock, which clogged up the ports, clogged up the transportation systems. And by the time all this inventory arrived of new merchandise, consumers had pivoted away from goods to services because services started to open up. So I think the goods recession is bottoming out. The purchasing managers indexes are still below 50, but in the goods sector, it looks like it's bottoming out. Meanwhile, the services purchasing managers index remains above 50, so that part of the economy continues to do well. Commercial real estate is in a rolling recession, but again, we have to be very specific. It's mostly office buildings, old office buildings in downtowns that are in a severe recession. Brand new, state-of-the-art office buildings are doing well. I don't know if they're doing extremely well, but they're doing well. I know there's some malls that went out. There was one in Arizona that went out of business and was purchased by somebody who converted them to a pickleball facility that apparently is doing very well. I think that speaks to the extraordinary vitality of the capital markets in the United States. During the Great Depression, there was no such thing as a distressed asset fund. Today, we have a whole industry of distressed asset funds. The innovation came from the government, actually. It was the Resolution Trust Corporation that came up with the idea. And now there's just tons of money that's always looking for bargains. And this clears the markets very rapidly. It means that somebody loses a lot and somebody gets a really good deal. And when they buy these deals, they already have the wherewithal, the funding for converting them into successful properties. And so there again, I think we have a situation where, yes, it's a negative for the economy, but there are ways to cushion the blow to the economy. The consumer obviously is the key here, and pessimists, including people who should know, like Jamie Dimon, have been saying that we're going to fall into recession when consumers run out of excess savings. That's been an argument that Jamie started to make. We're on a first name basis. Actually, I don't know him, but everybody calls him Jamie. So Jamie Dimon started in May of last year saying that, everything looks pretty good right now, but the hurricane's coming. The only reason they look good right now is because consumers have excess savings. When they run out of that, consumers will retrench, and we're going to have a recession. So beware, be prepared. And he's still basically saying that. The problem with that story is that it hasn't worked so far. Maybe it's about to work. Maybe consumers still have some excess savings, a few $100 billion here, a few $100 billion there, but they're going to be running out of them shortly. So if the recession didn't happen in 2022 or 2023, surely it'll happen in 2024. And besides, everybody knows that tight monetary policy has a long and variable lag. Maybe it's longer and more variable this time, but a recession is coming. The problem with that story is people like me. Many years ago, when I was younger, I know I still look quite young for my age, anyways. When I was younger, I thought I was actually pretty special. I thought I was quite unique. I had a little bit of a egotistical streak in me. And then as I got into this business and started to study the economy and try to understand what makes it work, I realized there are 75 million other people like me, baby boomers, who were kind of doing the same things, going to college, getting married, moving to the burbs, buying minivans, renovating their kitchens with steel appliances. And, we had this mentality that you started out as maybe as a AVP, then you became a VP, an EVP, an SVP. You tell that to younger people today is what are those codes for? They don't have this concept of rising in a corporate situation. For many of us, it didn't quite turn out to be quite that way, but that was the mentality. Anyways, we've got 75 million baby boomers now that are turning into seniors. They did a lot of savings. One of the reasons we have a lot of wealth inequality in our economy is because of Spock. Spock famously said, "Live long and prosper," and that's what a lot of baby boomers have done. They've lived long and they've prospered, and they've got a tremendous amount of wealth.
Wow.
The net worth of American households today is $155 trillion. That's with a T. $155 trillion. Half of that is held by baby boomers, according to Fed data. So something like $75 trillion, $80 trillion of net worth is held by baby boomers. And guess what? They're retiring. And suddenly they're saying, well, why did we save all that money? Well, it's for the kids. No, it's not. They never listened to us. They didn't like their friends. The hell with them. Let's go travel. Let's go spend the money. So I think a lot of the retiring baby boomers are spending money. I'm not retiring because a personal matter here. I got married 3 times. I got 5 kids. So I'm still working for a living. I think that should also make it clear to you that I'm an optimist at heart, which is maybe why my calls have worked out, because the world hasn't come to an end as the pessimists have been predicting. But 40% of households that have a house don't have a mortgage. And I guess a lot of those are going to be older householders. A lot of the older folks are enjoying record interest income now that interest rates are up. Dividend income is at an all-time record high. Proprietors' income, for those that are still working like myself, all-time record high. And wages and salaries are at all-time record highs, and they stalled relative to prices during the pandemic, but now wages are rising faster than prices, I think because productivity is making a comeback. Which gets me to the bottom line of where I think we're heading. Looking ahead here, I think we are in the roaring 2020s. I've been writing about the possibility that as we look at the decade ahead, that there are 2 alternative scenarios. One is the great inflation of the 1970s 2.0, kind of another round of a great inflation. And that certainly has looked credible for the past couple of years as a possible outline for where the 2020s was heading. I've been arguing, especially in the past 6 months, that inflation is turning out to be transitory after all, not persistent, that a lot of the inflation has been pandemic related to the shock of the pandemic, the aftershocks. I blame my wife for it. She went out and bought the last outdoor dining room set in May of 2020, and prices went up dramatically as other people try to buy dining sets, etc. We also bought 2 couches that took about 6 months to get delivered, and we completely repainted the inside of the house. So we finished doing all that, and then we went sightseeing around the world, and there was a lot of fun. Except the airports were mobbed with other people like ourselves. But looking ahead here, I think inflation is turning out to be transitory after all. I think productivity is making a comeback because the biggest problem that we have economic problem we have in our economy right now is a shortage of labor, particularly skilled labor. And as a result of that, I think companies are scrambling to use technology to increase productivity. And we've never had the kind of technologies that we have today that are capable of increasing the productivity of every business. In the past, there was manufacturing that was a beneficiary of technology that could increase productivity. In the 1990s, we had Excel and they had Word. And if you had a lot of secretaries typing on Selectric, that would increase your productivity. If you had a lot of bookkeepers, accountants, you could increase your productivity with Excel. But it didn't lend itself, those technologies didn't lend themselves to every business, or they didn't lend themselves to really making a big dent in improving productivity. But in the past, we've had some productivity booms, and I want to give you a quick look at that. And Marty, let's see if I can share my screen here with you.
Yep.
Okay. So this chart package is short. It's called Deja Vu All Over Again, the 1970s or the 1920s, and I think it's the 1920s. So it's the roaring 2020s. So if you in my scenario, stock market, I thought would be heading to. See if I got this. You can see
on a slideshow.
You can see the screen, all right?
Yeah, but you want to put it on a slideshow? It comes out bigger.
Yeah, hold on. Let's see what's going on here. Is that better?
Yes.
Is that good? You can see the
Okay.
end?
Yes.
Okay, good. This is the stock market. I thought that the October 12th low of last year was the low in the bear market. I said that in early November of last year. I thought that we could get to 4,600 by the end of this year. We got there by July of this year. I thought that we might have a pause there. We had a correction instead that lasted just a few months and was a conventional correction of 10%, exactly hit this uptrend line. Then I thought that we'd be back to 4,600, which is where we are. I think we're going to go to 5,400 on the S&P 500 by the end of next year and 6,000 by the end of 2025 in this roaring 2020s scenario. Meanwhile, while the pessimists have been focusing on everything that could possibly go wrong, Marty, are you still seeing the full chart? Yes. Good. So while the pessimists were focusing on everything that could go wrong, I was listening to them very carefully. I'm kind of lazy, and I figured if they're going to do all the work on everything that could go wrong, I should just pay attention to them and see what they're talking about. What I try to do is balance it off by saying, well, that's a good point, but there's things that may not go wrong. But I didn't buy into the inverted yield curve. I didn't buy into the falling leading indicators. I'm not saying those couldn't still be right and that we couldn't still have a recession. But I think the odds of a recession next year remain very low. I call it the Godot recession. The damn thing just won't show up. But we still have what I call die-hard hardlanders who are convinced it's going to happen next year. Even some of my friends, competitors that are very smart, Ed Hyman, for example, ISI, BSA, they're talking about a recession next year. Jamie Dimon's still talking about a recession next year. But I think the consumers are going to continue to spend. And as you can see, the consumer drives the economy, and I think consumer spending continues to move to record highs next year. You really have to see jobs decline to have a recession. And with baby boomers going out to restaurants, we need a lot of restaurant workers. With them traveling a lot, we need a lot of airline workers and hotel workers. And then between the meals that they're having before the early bird special for dinner, they typically go in to see their doctors. just to make sure they can keep doing all this. And so healthcare industry is absolutely booming. So you put all these things together, and there's still a lot of demand in many sectors of our consuming economy that are creating lots of jobs. So this is personal consumption expenditures per household. This is real GDP per household. Real GDP consumption per household is continuing to rise. The uptrend is there. We're all-time record highs. A lot of this has to do with an observation of mine, which is when Americans are happy, we spend money. When we're depressed, we spend even more money if we have it. And we've certainly been doing a lot of that of late. This is households' net worth. I mentioned to you $154 trillion. Half of that is the baby boomers. This is the inflation story. And as you can see, we did have the great inflation back here in the it was really the mid 1960s when Johnson financed the Vietnam War with deficits that we had the beginning of that inflation surge. And we had two energy shocks that went straight into wages as a result of cost of living adjustments in 35% of the labor force, which was unionized. Now 6% of the labor force is unionized. We still certainly have a deficit problem more than ever. We have a debt problem more than ever. And the bond market worried about that a great deal during the summer. But they say don't fight the Fed. They should also say don't fight Janet Yellen, because Yellen on November 1st said, okay, the bond market doesn't like all these bonds, we'll just do it in bills. And the bond market was actually happy with that. So that's okay. We like that idea. And the other thing the bond market liked is inflation's been coming down. And so, yes, the debt and deficit are bearish, but inflation is bullish. I think we're going to fall down to the Fed's 2% target by the end of next year, which is well ahead of what the Fed thought they'd be able to accomplish. And I think it's immaculate disinflation. I think we are seeing inflation coming down without a recession. You know, we don't have to have a recession to bring inflation down. I know history, if you look at this chart, says, well, wait a second. In almost every instance, in order to bring inflation down, we had to have a recession. There was this one exception here, a brief exception, when the soldiers came back from World War II. They all wanted to get married. They wanted to buy houses and consumer durables. And Henry Ford was building bombers rather than cars. So manufacturing had to swing quickly to make consumer durables. So this was a lot of consumer durables inflation that then came down, but then we had a recession over here that continued to bring it down. This time, I think what's different is that we don't have to have a recession because our good friends, the Chinese and the Europeans, are doing it for us. Especially important is the Chinese. China is in a depression, certainly a property market depression. It's bigger than anything we had back in the great financial crisis, bigger than what the Japanese had in the late 1980s. And as a result of that, their economy is depressed. Their consumer prices are deflating slightly. Their producer price index is deflating by about 3%. And so their exports to us, those prices are coming down. We haven't completely deglobalized. We haven't completely de-linked from China. We still get a lot of our goods from China. And meanwhile, Europe is weak. So goods inflation has come down dramatically. And now we're just waiting for rent inflation to come down because it's a laggard, and it will undoubtedly come down. So here's the story on productivity. We get some of our best productivity numbers. This is the 20-quarter percent change in it's the productivity cycle here. You can see we had a productivity boom in the 60s. We had a productivity boom here in the coming out of with Ronald Reagan. It was a small boom. Another productivity boom here in the 1990s. And I think we're in the early stages of a productivity boom now that'll get productivity growth up to 3.5 to 4.5% before the end of the decade on a 5-year trailing basis. And you can see that we get some of our best productivity booms that coincide with a very tight labor market. So there's a widespread perception the growth is bad because unemployment is too low. That leads to wage inflation. That leads to price inflation. So too much growth is inflationary, and the only way to bring inflation down is by having less growth, more unemployment. This view of the world is much more positive on growth if it's productivity based, and that's I think what we're experiencing. So companies are spending now something like 50% of their nominal capital budgets on technology, up dramatically over the past several years. I think they're going to be continuing to spend more and more of their capital spending on technology to boost productivity. And so here's that productivity cycle again. During the great inflation, productivity collapsed from 4% down to 0. During the roaring 2020s, I think productivity is going to increase from 0.5% at the end of 2015. I think it's going to increase to 3.5 to 4.5%, which is all good, because the arithmetic of real GDP is very, very simple. Real GDP growth is simply productivity growth plus labor force growth. If labor force growth is slow and you have no productivity growth, then you're going to have a very weak economy. If you have productivity growth, which is what I think we will, you get wages rise faster than prices, profit margins remain high, inflation stays low, and you get lots of growth that is based on productivity. And that's what I think is still ahead of us. And that's why I've got the stock market going to 5,400 by the end of next year, 6,000 by the end of 2025. What do interest rates do in this environment? They don't do much. They kind of stay here. I think everybody's been freaking out about the Fed tightening by 500 basis points. Well, that's something to freak out about. Obviously, it's an unusual situation where they have to catch up with the inflation curve, and they said that they're going to be inspired by Volcker to raise interest rates aggressively. But I think what's important to recognize here is that the Fed hasn't just really been tightening; they've been normalizing. We had an abnormal period between the great financial crisis and the great virus crisis, in which they kept interest rates abnormally low. I mean, they had this obsession, fear of deflation. I don't really have a problem with deflation. There's nothing wrong with falling prices. Consumer durable goods prices have been falling for years, and that's to the benefit of consumers. But they were paranoid about deflation, and they tried to bring inflation back up to 2%, and they couldn't do it, and kept interest rates near zero. Negative interest rates in Europe completely distorted the capital markets. And now what we're seeing is, in 3 years, the ECB, the Fed have normalized. The interest rates are back to where they were before the great financial crisis, to levels that are fair to investors who don't want to take a lot of risk and want to be able to buy government bonds at a decent return relative to inflation and in nominal terms. So I think the 4 to 5% could very well be the 10-year yield for a while. We are probably we're not out of this debt crisis situation. I know Ray Dalio has been predicting things are going to be pretty gloomy because of the debt crisis. I think the fixed income and equity markets have figured out that we're not going to do anything about it between now and election time, and let's revisit this thing after the elections. So I think it's still an issue. We are going to need to deal with the deficit. By the way, economic growth based on productivity better than expected could really help a lot on reducing the burden of that kind of debt. So that's my happy story. I'm not going to tell you that things can't go wrong, that there isn't another side of the story. But the other side of the story, the bearish case, the pessimistic case, kind of gets all the attention, gets all the press, and I've tried to be somewhat more balanced. If you want to get a kind of a tasting menu of what we do at Yardeni Research, it's right there on the screen, YardeniQuickTakes.com. If you want to get the full service, you can try Yardeni.com. There's a 4-week trial of our institutional service. So Marty, there, I've given you my presentation and my commercial, and
Yeah. So Ed, can you take down your presentation so we can see you on full screen?
yeah, sure. Okay, I'm back.
So before I know Steve McCarthy wants to say something, but I got to cut in because he'll just go on. So you know,
I've seen him before.
so Ed, you know, there's in tennis they have something called keeping your eye on the ball, right? And actually, when you play basketball, it's one of the things you want to keep your eye on the ball. So what's the ball to you? Because it seems like you focus on what the Fed's going to do more so than a lot of the. I mean, sure, there's a lot of other indicators, but it's whether the Fed has a response to it, right? So maybe you can talk about that a little bit from a philosophical point of view.
Yeah, I wrote a book a couple of years ago called Fed Watching for Fun and Profit. My only regret is I should have called it Don't Fight the Fed, which, you know, is something Marty Zweig back on Louis Rukeyser kind of was his motto. And it's, you know, it's something that has been clearly very, very important. I know there's a lot of people that are critical about of the Fed. I just kind of observe what the Fed does and try to anticipate what they're going to be doing next. And they clearly have a very important impact on the economy. But at the same time, I try to be aware of something that I've observed over the years is that isn't it amazing, totally amazing, how well our economy does despite the Fed, despite the Treasury, despite Washington, despite the White House and Congress. You know, the government more often than not is just a pain in the ass. And what's amazing is that all of us, you and me, we come into the office or home office or whatever, and what we spend our whole day doing is trying to figure out how to make things better for ourselves, our family, our community, our country, incorporating in our planning what we have to do to deal with the government. And as a result of that, the economy's prospered. It's sort of us versus them, but they're important and they write a lot of the rules. But it's amazing how many of us succeed in making things better for the economy and so on. And so I think it's not all about fiscal and monetary policy. I think you really have to factor in that there's us working for a living. The problem with working for a living is it really doesn't give us much time to fend off all the politicians that are constantly trying to pick our pockets. But it is what it is, and we have to deal with it. And still, all in all, I can't think of a greater country than America in terms of one where entrepreneurial capitalism can still thrive, which is another book I wrote called In Praise of Profits. So you can look on Amazon for some of my books, but
that's a great book, Ed. Thanks so much for sending it to me. So we have three other questions. Actually, we're going, okay, I have 10 questions. But Steve McCarthy, you were first. Why don't you?
Sure. Good to see you again, Ed. Name's
My
Steve
pleasure.
McCarthy, KCG Capital Advisors. Last time I saw you, you were sitting next to me at the Gotham Triangle. You sound like my father, Jack McCarthy, Lord Abbott, the raging bull. Okay. Let me give you a couple of quick ones here. A couple of colleagues, Gundlach and a couple others say federal deficits out of control. We got 6% of GDP. We're right $1 trillion in interest rate payments. Number two, the consumer, by the way, it was overstated how much money they got. Flat back, delinquency is going up, student loans going up. You know, I'm not sure we can buy into the Goldilocks, you know, soft landing, everything like that. You talk about two shocks. One was the consumer shock, and the other one was, you alluded to it, the baby boomers. We're retiring in record numbers. What's the labor force participation rate going to do? And how does that play into your thesis?
Yeah, with regards to debt, I think it's very important, and you all know this from what you do for a living. The government's debt is our wealth. I mean, somebody just keeps buying the debt. I mean, okay, so you didn't like it at 4%, you had a chance to buy it at 5%, and now if you didn't get it at 5%, you know, well, maybe 4.25 isn't so bad if inflation continues to come down. And so far, Ray Dalio has been wrong. I mean, I'm not dismissing the debt crisis. I think it's the number one issue that we're confronting on a longer term basis. But there is an interest rate at which the debt will be purchased. And that just speaks to just how much wealth is being generated by our country. Country has never had $155 trillion of net worth in the household sector. We've never had a generation like the baby boomers that are so wealthy that they're not going to be able to spend it all. They're actually going to have to leave some to their kids after all. And with regards to the consumer, Peter Lynch always said, look at your own life as a way to think about what's going to work here. Again, I got 5 kids, did it with 3 wives. Two of them just graduated from college, and past 4 years is like, shoot me now. I can't believe I'm spending this kind of money on this kind of useless education. I don't even remember what the first 3 cost, because I just don't remember it was much of a problem. But guess where the 2 graduates are living right now? Right here at home.
Brooklyn?
It's rent free. The food's free. The laundry's gets done. But in talking to other people, I see we're not the only ones who have our kids still living at home, and you got to feel bad for them. I mean, rents are ridiculous. Costs are ridiculous. So there is already a lot of intragenerational transfers going on between the baby boomers and even before we die, we're giving them money. And so I think that's keeping the consumer going, and something that people aren't factoring in as a macroeconomic phenomenon.
Hey, Ed, back in the old country, your kids living at home used to be called tradition. But anyway, Bitcoin, any thoughts on Bitcoin?
Really none at all.
Okay, next. Okay, by the way, Ed, I want to bring up a point about Ray Dalio. Is that Ray Dalio said it's going to be the China century, and then you pointed out a couple of weeks ago you had some comments on China also. Can you summarize your thoughts in 30 seconds?
Yeah, China.
On China?
Less than 30 seconds. China's run by commies. Do not invest there.
Okay, great.
Short and sweet.
Okay, and I really like your chart package on total assets of major central banks. In there, you have a chart about the correlation between the S&P 500 and the Fed balances. Are you saying that correlation is now broken based on your outlook, S&P 500 6,000 at the end of 25? And then the second part of the question is, if the Fed starts easing up, what comes first, interest rate cuts, or will they ease up on the monetary tightening? And when do you think that would happen?
Well, with regards to the Fed, the past couple of years, everything is really dependent on which side you were on. Were you on the hardliner or softliner camp? For a while there in the third quarter, it looked like neither camp was right, that the economy was absolutely booming. But it's basically been a hard versus soft landing choice here in this tug of war in the marketplace. With regards to the coming year, those who think that we're still going to have a hard landing, many of them have softened it up. They're talking about a shallow recession. But those people tend to say that the Fed's going to cut the Fed funds rate by at least 100 basis points, at least 4 times. And I say that they'll probably do it by 2 times, by 50 basis points. Look, if inflation continues to come down as much as I think the Fed's going to be lowering interest rates, not because of a recession, but because they'll realize that if they keep rates where they are and inflation's coming down, that in fact will be more restrictive. Real interest rates will be going down. So I think you'll see them talking about, well, we're getting pretty close to our target. We don't want to be too restrictive. We don't want, we've achieved so much in bringing inflation down without a recession, what I and others have called immaculate disinflation. Why screw that up and have a recession now if we don't have to? So I think 2 rate cuts may do it. I think their experience of the past couple of years has really focused them on really their number one mandate, which is to keep inflation down. And so I think that's where I'm on. I didn't quite hear your question on the stock market. You're saying how can the stock market go up if the economy is weak? Is that
No. You had in your chart packet on total assets of major central banks. You showed a correlation between.
Oh yeah.
And S&P 500. Is that correlation broken? That's the question.
Yeah, I see you're referring to my website where I've got charts of the S&P 500 versus the assets of the Fed, or you could take the all country world stock market index, MSCI, and see that's correlated with the assets of the central banks. And I've been showing that chart and saying this is probably one of the main charts that the bears keep alluding to. And I said, yeah, you could put that on the bear side, but I kept looking at what the economy was generating in earnings. The market historically hasn't really followed the track of the assets of the central banks. It's followed earnings, and it's PE times E. It's real simple. I used to be an economist. I became a strategist because it was too hard being an economist. I figured strategy is easy. It's PE times E. It's getting those two variables right that's hard. To forecasting them is easy. But I've been bullish on earnings this year. I thought would be 225. They're coming in at 220. The bears were talking about 180. I've been talking about 250 for next year for earnings. The bears have been saying that's delusional. And I'm even more delusional about 225 at 270 and 226 at 300. So 226 at 300 by the end of 2025, if that's what analysts agree with me on, put a 20 multiple on that, you get 6,000. Now, why would you possibly want to put a 20 multiple, since that would be insanely high relative to a fair value historically of 15? Well, 30% of the market now is the mega cap 8 stocks, and they're not going to go away. And they have a very high valuation multiple. And I think all companies, all stocks should be viewed as technology stocks. You're either making technology or you're using it. If you're not using technology, you're not a technology company. You're going to go out of business. Do not invest there. But I think everybody has to use technology now to increase their efficiency and productivity, or else they'll go out of business.
That's interesting, Ed. So we have got two more questions, but the answer had to be 30 seconds or less. So, Alan?
You talked about a huge increase in productivity, but I didn't hear, maybe I didn't listen carefully enough, what was going to cause that productivity ramp up.
What's causing the productivity boost?
Technology, well, the underlying technology solves problems. When I studied economics in school, I started out with Samuelson's book, and in Samuelson it taught everybody that economics is the study of the optimal allocation of scarce resources. That is so depressing. I mean, really, that's what it's about? I mean, there's only so many resources, and we have to figure out how to allocate them. No, economics is about how technology solves economic problems. The economic problem we have now is a labor shortage. How do we solve that? With technology, with productivity. And we all know the story about AI and automation and robotics. We all know that construction of manufacturing facilities in the United States is soaring because of onshoring, because of the government subsidies. These are going to be state-of-the-art manufacturing facilities, and everybody's got to use technology to increase productivity. And that's
great.
That's the story.
One more question, but
well, just I had breakfast with a gentleman at his own construction company. He has 200 employees, makes multifamily homes throughout the country. And he mentioned the architectural. He used to hire a bunch of architects to do his work. Now he uses just an AI software program to do all that. So I know you just mentioned it, but the use of AI and its effect on the skilled workers, where we have a shortage of workers, but as you mentioned before, it's really the workers, people at service in the service industry. So that continues to develop. I have a question for you on that. Are you using AI as you do all the data analysis and so on, and what you do, and just the overall?
Are you using AI yet?
Yeah.
I tried it. I tried Chat GPT, and I tried the other ones, and it's surprising what it could do, and it saved me a tremendous amount of time until I read what it wrote, and then I had to spend more time editing it. So
okay, last question
for me, it's useless.
Do you believe that there's a great rotation, energy, minerals, mining, precious metal rally, and Magnificent 7 or 8 rolling over?
No, I think that the China is going to remain depressed. I think Europe's going to have a shallow recovery. I think the U.S. economy is going to have a productivity based boom, and in that scenario, I think commodity prices stay down, oil prices stay around here, and in that scenario, technology, financials, industrials do well. I would have a position in energy. There's a good yield in those stocks, and I think the climate activists have convinced the producers to spend less on producing what they have, so they get so that their costs are down, and meanwhile their prices are still pretty good.
Perfect, great. Well, thank you so much, Ed. It's really fantastic. And again, Ed's batting like 700, 800 right now. So
Thank you very much. All
All
the
right.
best, everybody.
Thanks so
Happy
much, Ed.
holidays.